All right. Hello, everyone, and welcome. My name is Sarah. I'm the Director of Outreach at NYSARC Trust Services. And we thank you guys for joining us today to learn more about planning for the future of a loved one with disabilities using tools like special needs trusts, pooled trusts, and ABLE accounts. NYSARC Trust Services is a not-for-profit organization, and we have been administering special needs trusts since 1972. So we're actually celebrating our 50th anniversary this year. NYSARC was established by NYSARC Inc., which is now known as the ARC New York, which is a family-based organization that serves people with intellectual and developmental disabilities. So we got started helping families and parents plan for their loved one who receives needs-tested government benefits. And we primarily administer first and third-party pooled trusts. And in today's training, we're going to be talking about the different types of tools and the differences between special needs trusts, pooled trusts, and ABLE accounts. We're going to provide some information about how to get started, how you can use the trust to improve the quality of life of your loved one or someone who you're working with. And we're also going to take some time to introduce our new third-party pooled trust program, which allows NYSARC to provide services to people with any type of disability. Now, we do serve people who reside in New York State. We serve all 62 counties of New York. And so for parents or families who may be tuning in from another state, if you're looking to fund a trust for a loved one, they just need to receive New York-based benefits in order to use our programs. Now, the content of today's presentation will be also covering trusts in general, so it should be applicable to anyone. Our services are also available to people with disabilities of all ages because we administer pooled trusts. It's actually one of the only options for someone to protect their own money once they're over the age of 65. And we'll get into that in more detail when we get into the overview of pooled trusts. And in New York State, as a not-for-profit organization that administers these trusts, we also have the requirement to partner with a financial institution who serves as our co-trustee. And so joining us today in our webinar is KeyBank, a couple of members of the KeyBank team who NYSARC has been working with for a number of years. And when you partner or choose NYSARC for your trust administration, you get the benefits of working with a nonprofit organization that understands benefits and the needs of people with disabilities, and a financial institution with 190 years of wealth management experience, particularly a fiduciary, which makes a real difference. So I'd love to just take a moment to say hi to Cindy and Vince from KeyBank, and thank you guys so much for joining us.
Hi, Sarah. Good to be with you today.
Hi, Sarah. Hello, everyone.
Wonderful. And so as we go through today's training, KeyBank is going to jump in to talk a little bit about their role as trustee, what the strategies are for managing assets in a trust to ensure that that money is available to a person throughout their lifetime and that we can maximize the benefits they can receive from those funds. And they are going to help us also close this out with a little bit of a discussion on the benefits of using a special needs trust when you're considering leaving retirement assets to a loved one, and what some of the advantages of using a special needs trust are under the new Secure Act law. Before we jump in, I just want to cover a couple housekeeping items. Just be aware that the information that we're providing in today's training is really just for educational purposes. We provide these trainings free of charge so we can help people understand how trusts work, consider what options are available to you, and help you get started in doing some research. Some of the information may be subject to change in the future, and we encourage you to speak with a legal or tax professional anytime you're considering planning for the future of a loved one, looking at your assets and estate planning. That's always going to be essential when you're doing this type of planning. We do encourage you guys to submit any questions you have in the chat. We do have some members of our team who are on the line. I'll be monitoring the chat throughout today's webinar, trying to jump in and answer any questions as we can. And we will reserve some time at the end to open it up and go through those questions together. So we encourage you to participate. Please do that in the chat. So people with disabilities who receive Medicaid or Supplemental Security Income benefits, or who may need these benefits in the future, can only have a certain amount of money in their own name available to them and be financially eligible to receive services through these programs. That can make it difficult for a person with a disability to save money and be able to plan for the future when they're constantly having to make sure that they are spending down any money that they have available to them so that they can keep their benefits. By using some of the tools we're going to be talking about in today's webinar and properly planning and doing early planning, you can ensure that your loved one has the ability to save money without losing their benefits or causing any sort of reduction in those benefits. You can help them protect those benefits in an event that they come into a sum of money that might put them over the financial limits to qualify for those programs, which allows you to protect their ongoing eligibility for those benefits, avoid interruptions in services or reductions in their services that they're eligible for, and it allows you to plan for future wants and needs. Build up a nice nest egg that can be available to your loved one to provide for things that they want now and in the future, and ensure that they have the means to improve their quality of life, to give them the best quality of life possible. The type of life that all of us here on the line are very accustomed to and expect. Now, there are a couple of different tools when planning for the future of a loved one that you can use in order to protect their eligibility for benefits. Special needs trust is primarily what people use. It's been around a long time. A standalone special needs trust. These are allowable under federal and state law, and they're designed for people with disabilities so that they can protect income and assets while maintaining their financial eligibility for those means-tested government benefits. Now, a standalone special needs trust, or for the attorneys on the line, is often referred to as a D4A trust. This is a trust where you go to a legal professional and you have the trust drafted during your lifetime, or it could be something that they are working with you to set that trust up to be established through your will or estate planning documents. You, as the individual either funding the trust or the donor looking to set money aside for a loved one, would need to select a person or a professional to serve as the trustee of that trust. And that's going to allow that person or organization to manage that money on behalf of your loved one in order to allow them to keep their benefits and use those funds for things that go above and beyond what their benefits provide. Now, in addition to special needs trusts, there's also pooled trusts, which is a type of special needs trust, which is managed by a not-for-profit organization. So unlike a standalone trust where you need to go to an attorney, have a document drafted, pooled trusts are managed by one master trust document that governs the entire pooled trust and how it's administered. And you simply apply to join that trust. So you don't need a legal professional to draft the document. However, it's always a good idea to consult with a legal professional anytime you're doing any sort of trust planning. And depending on your situation, an attorney may or may not be required to set up a pooled trust. Additionally, because the pooled trust is run by a not-for-profit organization, it's usually going to be an organization that works with people with disabilities and understands their needs, can provide maybe a little bit more of a personalized level of service, and usually at a reasonable cost compared to some other professional trustee options. And then you also have the option of an ABLE account for those individuals who had a disability prior to age 26. They're eligible to set up ABLE accounts, which are modeled after the 529 savings accounts. And it allows an individual to also put money in it that will not impact their financial eligibility for benefits, up to $16,000 a year to be used for qualified disability expenses. So a little bit different the way that is set up. And we can really talk about able accounts, for the entire webinar, the amount of information that we could share. So we are going to be just touching on this briefly and talking about some of the differences throughout today's training, but we encourage you to go to our website. We have some great resources about the differences between able accounts and SNTs, and we have a previous webinar training talking just about that topic. So we encourage you guys to go to www.NYSARCTrustServices.org and check out those resources. Now, there are two main types of trusts, and it comes down to how it's structured, primarily who's funding the account. So a first party trust is a trust that's funded by the person who is in need of the services, the individual using their own money. This is typically needed when someone is already getting benefits or is looking to apply for benefits and has funds in their name that they need to spend down in order to be financially eligible to qualify for those services. It's typically when someone comes into a sum of money that's going to put them over those limits to qualify for services. And in some cases, depending on how much money they're receiving, that money can be appropriately spent on the individual within a given time frame, and they're able to maintain their eligibility for benefits. Other times, that money might be coming from a direct inheritance, proceeds from a settlement, maybe a big retroactive benefit payment, even wages for someone who's working. And it may benefit that individual to put that money aside in a trust where it can be used throughout their lifetime, instead of having to be spent down quickly and oftentimes frivolously in order to maintain their eligibility for benefits. Now, depending on who is funding the trust, in this case, when a first party is funding the trust for their own benefit with their own money, there is a payback provision in the trust that Medicaid should be repaid upon the death of the beneficiary with any funds that are left in that account. That money should go to repay their Medicaid lien for the services that were provided to them during their lifetime. With a third-party trust, this is a trust that is funded with someone else's money, someone other than the person who's going to benefit from the trust. This could be a parent, sibling, grandparent, really anyone who wants to leave funds to a loved one and wants to do so without impacting their financial eligibility for benefits. It could be money or assets like real property, and could be things like proceeds from their estate, life insurance policy, retirement benefits. There are really so many things. This could be funded either during your lifetime or at your death with those proceeds from your estate. And so it's important to keep in mind that even if you don't have a large estate or significant assets, you may still have a life insurance policy or retirement benefits that you want to ensure goes to your loved one without going to them directly. Because when you put that money into a trust, rather than giving it to them directly, you're able to avoid that Medicaid payback I was talking about earlier with the first party trust. Because it is someone other than the person who's benefiting from Medicaid or SSI who's funding that trust, there is no requirement to repay Medicaid with money upon the death of that beneficiary of that trust. Now, with ABLE accounts, these can be first and third party funded. A person can only have one ABLE account, and any person who's adding to that account, it could be first party money or third party money, all go into that one account. And so for families who are considering leaving funds to a loved one, an SNT provides some advantages over an ABLE account for that reason. However, it can always be good to have both whenever possible. An ABLE account is an excellent complement to a special needs trust and overall a plan for the financial needs of a loved one with a disability. A special needs trust, however, a person can have many trusts. They can absolutely have more than one trust. might start out with one third-party trust that their parents funded for them. They may have a separate third party that their grandparents started. And perhaps at some point in their life, they have a need to create their own trust. So that's its own standalone first-party trust. So a person can have many different special needs trusts. And there's no limit to the amount of money that you can put into a trust. Unlike an ABLE account, where you can only put up to a maximum of $16,000 a year, there is no maximum of what you can put into a special needs trust. These trusts are irrevocable in order to protect a person's financial eligibility for benefits. So you may be familiar with a revocable trust where you can go in and make changes whenever you'd like. Once funds go into a special needs trust, they become the property of that trust, and they are managed on behalf of that person to help them use the funds for qualified expenses. The beneficiary, who is the person who is benefiting from the trust, and anyone who they authorize to have access to that account, or perhaps a liaison who may be working with the trustee, can make requests to use the funds in the account. Then a trustee will distribute money to third parties to pay for eligible expenses. And it's very important to distinguish that we only pay third parties, meaning that you want us to pay for a cable bill, you submit a request to pay the cable bill with a copy of that bill, and we're going to pay the cable company directly rather than giving that money to the individual to pay that bill. That could actually impact their financial eligibility for benefits or be treated as income to that person. So that's one of the ways that we are able to protect someone's eligibility for benefits. And a trustee, when you are establishing a standalone special needs trust, you have the option of choosing who you want to serve as that trustee. That can be a family member or a friend, really any person who you trust, who is willing and able to serve as the trustee. That can give you a little bit more flexibility, perhaps direct access to the funds in the trust. And oftentimes those services come free of charge. Most times your family is not going to charge you for those services. However, we'll go into some more details on the next slide of kind of the responsibilities of a trustee. That individual may lack the knowledge or the resources to appropriately administer that trust. So it's very important to consider very wisely who you choose to serve as trustee. They're also going to be someone who is in charge of managing that money. And so that can put some some strain on the relationship between that family member when you're the person that's holding the purse strings and has to say yes and no when it comes to using the funds in the trust. So again, we just want to be sure that we're considering all those factors and also being sure that we set ourselves up to have a successor trustee in the event that that person is either not willing or able to serve when the time comes. You can also select a professional. They may be a little bit hard to come by, but there are some individual professionals who do provide trustee services, and a bank is another option. However, many banks and financial institutions will only take on trusts of a certain size. Their minimum funding requirement is $500,000. So that can make that, unfortunately, inaccessible to many families. Another option is using a pooled trust. As I mentioned, a pooled trust is managed by a not-for-profit organization. It is, again, typically an agency that works directly with people with disabilities, understands the rules of government benefits, and can provide that personalized level of service at a little bit more typically a reasonable cost than other professional trustee options. So when it comes to choosing a trustee, again, it's so important that you're considering and having these discussions with that person upfront of what are they going to be responsible for, and choosing someone that you know is going to have a good ongoing relationship with your loved one and who you know you can trust to use those funds for them and for purchases that are going to be in their best interest. A trustee is responsible for knowing the rules of Medicaid and SSI. and understanding how the distributions from the trust could potentially impact their financial eligibility for those benefits. These rules are often changing year after year. And so, it really is something that you have to take an active, role in understanding the benefits and staying up to date on those changing rules. They're also responsible for maintaining detailed records and being able to report to the appropriate government agencies as applicable and as needed throughout the administration of the trust. Because there are times where Medicaid or Social Security Administration may ask how funds in the trust were used, or they may want to see an accounting of the trusts. And so those are all things, maintaining detailed records, picking someone who is going to be responsible and organized. Those are all things to consider. This is also going to be someone who's going to be regularly communicating and interacting with your loved one. So you want to be sure that you pick somebody that's going to be a good fit for that. Someone that, has a good relationship with your beneficiary or with your loved one, who that person can trust, and that they're going to do things in the best interest of your loved one. As trustee, we're also responsible for annual tax preparation. So when you're choosing a trustee, dependent on whether or not they have that level of expertise, that may be something that you have to contract out for those types of services. Trustees are also responsible for prudent investment of the funds. And that's really important. When you are setting aside money that is intended to be used throughout a person's lifetime, it is important that you are taking a strategic approach to investing that money and doing so in a way that you're considering, many factors. How old is that individual? How much assets are in the trust? And with that, I would love to ask Cindy or Vince to jump in and just talk a little bit about your role as trustee and kind of your strategy for financial management of assets and why that's so important.
Sure.
Yeah.
Thank you, Sarah. I'll start, Vince. We'll
Okay.
talk about the whole role of trustee. So again, thank you for inviting us to join you today. We're very happy to be with you on this. I think it's a really important topic. And I laugh because I've been in the business 30 years working and managing special needs trusts. And when people talk about family members, I always say it is a hard choice because it is not a gift. It is a very hard responsibility. And for all the bullet points that you have on this slide. So we find that the partnership that we have with NYSARC is very unique and very solid because truly, as a not-for-profit, you're taking the lead. You understand the family members, the beneficiaries, their roles in which they play. And as a corporate fiduciary, we are there to help along the fiduciary side of the house. We're the ones helping with the preparation of the accountings and the tax returns and the prudent investment of the funds, as well as maintaining those daily records. It's hard when you're an individual. You may not have the understanding or the ability or even the time to manage through all of this to make sure that you're not writing a check to someone that may blow the person's benefits. And that's a huge responsibility. So that's why I think a partnership with NYSARC and KeyBank is so very solid and so good because, again, NYSARC as a not-for-profit, you work with these families day in and day out. You understand this industry, you understand the benefits, and then we're just there to handle the support behind the scenes and really support you as an organization to make sure that we're doing the right thing together as co-trustees. So, Vince, if you want to touch on the investment side of the house, that's your book.
Yeah. Thanks, Sarah. Thanks, Cindy. Welcome everyone tonight. Thank you for your time. KeyBank has, as you saw, been around for 190 plus years. We're the 11th largest bank in the United States, over 170 billion in total assets. So we take this stuff very seriously. And we have a long track record as a fiduciary to securely and privately managing our clients' assets. Our trust charter dates back, like I mentioned, 190 years. As a fiduciary, we have the legal, ethical, and moral duty to always act in the best interest of our clients. In contrast to many of our other wealth managers out there, they're only required to offer suitable investment advice. But as a fiduciary, as a co-trustee, we have to act in the highest interest, either equity or law, above and beyond for our clients. I mentioned fiduciaries have that higher standard of prudence than other investment advisors and wealth providers. And there's no self-dealing is permitted. Can we use these clients' assets to benefit us in any way? It always has to be on the benefit on behalf of our clients. So very, very important. Also, which is also important, some people know this, some people don't, but all of the assets that are held on our fiduciary platform, they need to be segregated from the rest of KeyBank's assets. So that's very important. There's a segregated accounting system that's not on the balance sheet of KeyBank. Federal regulations prohibit access by bank creditors to assets on the fiduciary platform. So that's very important. You know, our clients' assets are safe. They can only be acted upon by folks that are on our fiduciary platform, and they're segregated for the rest of the bank. So God forbid something were to happen to KeyBank, you know that their assets are safe. Maybe not necessarily from, stock market gyrations, but they're safe from, KeyBank potentially, or any institution going belly up if they're on the fiduciary platform.
Yep. As
far as the prudent person rule, we're cited, as trustees tasked with administering assets on behalf of our clients. We're restricted to the types of investments that we can put in these portfolios. We can only take reasonable risk for income, and we have to keep in mind preservation of capital. So we're not going to go out and take these assets and invest in, say, for instance, Bitcoin, for instance, or an IPO or something like that. We got to make sure that we have our due diligence, we're doing the research on the funds that we're investing in, and that we're not putting clients' monies at extreme risk by doing so.
Wonderful. Vince, thank you so much. That's such an important, distinction for people to understand, the relationship, the fiduciary aspect of what you do. And again, that prudent is the key word here, investment of funds. Again, we're working with people, and we have to ensure that this money is available to them when they want or need it. And so we take many strategies in planning for their future. So once you've decided that a special needs trust is a good fit for you or your loved one, or there's a need for benefits, and you select whichever option you want to go with, we'll certainly be talking a little bit about the process of getting started. A lot of people want to know, what can my loved one use the money for in the trust? So the list of things we can use the funds for is really truly endless. It comes down to, what does that person want or need? The goal of this program is to provide secure resources so that someone can pay for things that supplement their government benefits. We have to first make sure they're getting the maximum of the services they should be receiving through Medicaid and SSI, and the funds in the trust are only being used for things that go above and beyond those benefits. Now, according to the Social Security POMS, there is a primary benefit rule, which means that the funds in the trust should be used for the primary benefit of the person with a disability. So that typically means we can't buy gifts for other people with the funds. However, there may be some flexibility with third-party trust there. And we're going to typically be looking to use the trust funds for things that are only for that person, or for that person's primary benefit. There may be some ancillary benefits that go to some other third parties, but it should be for that person's primary benefit. So typically we're talking about items and services that are for that individual. That can be so many different things. It's very unique to a person's situation. What do they like to do? What hobbies do they want to be involved in? What are their needs? What do they need that money for? And we're going to be looking to really use that money to provide for life-enhancing things, even beyond things like uncovered medical expenses and things that are going to help them with their day-to-day. We have the flexibility to be able to use that money to do things that might improve their quality of life. We also, as Cindy kind of alluded to earlier, have to consider how paying for something could potentially impact someone's eligibility for benefits. For example, someone who receives supplemental security income, they receive those benefits to pay for food and housing. So if a trust were to pay for food and housing expenses, that could potentially cause a reduction in their SSI benefits that month. Now, the decision of whether or not that makes sense or not is something that's really, on a case-by-case basis. Someone's SSI check might only be $70 a month. And so if they have a large trust, and they want to get into a better apartment, we may use some of that money to pay for their rent, and they could, forego that SSI check because it's such a small amount of money. Others are receiving a significant amount from SSI, and it would really put them in a bad spot if we were to reduce those benefits on an ongoing basis. So those are some of the things that we have to consider each time we review a request, is how is that going to impact someone's benefit eligibility? One benefit to using both an S&T and an ABLE account in a situation like this is that ABLE accounts can be used for qualified disability expenses. And one of the qualified disability expenses is housing. And so this is a way where an S&T can work in complement with an ABLE account to provide some funds to be used for housing expenses that won't impact someone's eligibility for SSI. So again, if you have the ability to have both of these tools, it can be really beneficial to helping someone, again, maximize the services that are available to them and the funds that they have available to them. When you want to use the trust to pay for an expense or a service, we need to see some documentation of what that item or purchase is for, primarily to make sure that it is for our beneficiary and to ensure that we have the appropriate documentation to show proof of what we're paying for out of the trust. In the event that Medicaid or SSI wants to see that at some point in the future, we need to have that documentation. And we cannot make cash withdrawals or payments directly to the beneficiary from the trust. I touched on this a little bit earlier. This is for the protection of their benefits. If we could just put this money in an account and turn around and give it back to them, it would be considered available to them, and it would not protect their financial eligibility for Medicaid. So the trust pays third parties. We pay the cable company for an expense. If you would like to buy a computer, we would work with that person to shop for that computer, and we would purchase the computer from the vendor directly for them and have it shipped to them. So we are always going to be paying a third party, either a business or to reimburse someone for buying something on behalf of our beneficiary. So I have a brother with a disability. I go out and buy him a jacket. I hold on to that receipt. I send it to the trust, and I ask for reimbursement for that purchase. As I mentioned, the list of things that we can pay for out of the trust is truly infinite. It really depends on the person's, unique wants and needs. But typically, it's going to be things that go above and beyond their government benefits. We're looking to provide for items and services that are going to give them a better quality of life. Could be things like travel, entertainment, recreation. I can cover things that their Medicaid or SSI benefits do not provide. So if they have a need for a special piece of equipment that's not covered under Medicaid, perhaps it's over-the-counter items that are needed that are not covered by benefits. Those are examples of things the trust can pay for. Therapy, companionship services, we know that those are often hard to come by when it's not provided through government benefits. And also expenses that the person has, things like their phone or cable bills, other personal needs that they have, perhaps furniture, things to decorate their apartment. We have some beneficiaries who really like arts and crafts, some that like photography. It really comes down to what that person wants or needs. And in the event that the individual only receives Medicaid benefits, we can also pay for things like their living expenses, things like rent, mortgage, property expenses, renter's insurance, any sort of insurance that they have, vehicle expenses, car insurance, utility bills, food expenses. And we always encourage people to consider, if they have not already, set up an irrevocable pre-need funeral arrangement. This is where you go to a funeral home and you enter into a contract. It's a special type of contract that's irrevocable for Medicaid eligibility purposes. And you're able to pre-plan your funeral arrangements and prepay for those services. So that's taken care of and you don't have to worry about that later. So how do you get started? Now that we've discussed the options and the need for special needs trusts, The sooner the better, really. If you're a parent or you're a family member on the line, and you're considering, what assets you have that you want to leave to a loved one, there is really no better time to start than now or yesterday. You really don't know when something could happen to you. And so by doing planning ahead of time and early on, you can ensure that those assets go to your loved one in a trust rather than going to them directly. Again, that's going to ensure that that money goes into a third-party trust for their benefit, and that money can be transferred to other family members upon their death. To get started, you're going to want to start by meeting with an attorney, someone who specializes in elder law and special needs planning or trust and estates, who knows the applicable state laws, can review your goals, your current estate planning documents if you have them, or get you started if you haven't started that process. If you're looking at, maybe all your assets are simply your house and retirement accounts, maybe a life insurance policy, you're going to be looking to update your beneficiary designations to name a trust as the beneficiary of those assets rather than your loved one. That allows your loved one to receive assets that they're entitled to in a trust rather than directly. And so you're going to want to consult with a legal or tax professional through that process. As I mentioned earlier, if you're establishing a standalone trust, you're going to need someone to draft that document, update your estate planning documents to be sure that your assets transfer to that trust upon your death. When you're using a pooled trust, you simply apply to join a pooled trust. You don't need someone to draft a document. Those documents have already been drafted, but you will still want to work with a legal professional to be sure that that trust is properly included in your estate planning documents, and still to review, again, your goals and your overall plan to ensure that all of your documents and everything that you have is in good order and will meet the applicable state laws. Now, we've talked a lot high level about special needs trusts and the tools and why you may want to use this tool. And now we're going to spend a little bit more time giving you more information about what's unique about a pooled trust. And we're going to introduce you all to our new third-party pooled trust program. We'll talk about who may benefit from using a program like this and some of the unique aspects that may make this something for you guys to consider. So I've mentioned this a few times throughout today's training. One of the most unique things about a pooled trust is that it's managed by a not-for-profit organization. So you do not have to select someone to serve as trustee. However, you are able to name family members, anyone in your loved one's life who you trust, could be a professional, a case manager, social worker that they work with, to be authorized contacts on the account, which gives you the ability to be actively involved in the administration of your loved one's trust without having to take on that legal responsibility of serving as trustee. In New York State, pooled trusts are required to partner with a financial institution who serves as the co-trustee. And the financial institution could simply be a bank, or it may be someone more like KeyBank who has a fiduciary duty to the assets in the trust. So there's a clear distinction there, and it's very important to know who the pooled trust co-trustee is. Funds in a pooled trust are all pooled into one bank account for investment and management purposes. But as far as your loved one is concerned, their activity will be tracked in an individual sub-trust account. So it will still work like you have your own account, but the funds are pooled to provide the individuals who participate in our trust with lower costs. That's one of the ways we're able to spread out the costs of the administration of the program to provide more reasonable administrative costs to the people that we serve. And it also gives people the advantage of having their funds invested with a pool of other people. So your $10,000 sitting in an account on its own is really only going to go so far. versus that $10,000 being part of a much larger pool of assets all being invested together. So that is another added value of using a pooled trust beyond just the ability to protect a person's eligibility for benefits. The trust documents are already drafted and approved by the Social Security Administration, so you don't need to draft those documents and you don't need to submit those documents to Social Security for approval. If it's a first party trust, we do always want to provide a copy of that document to Medicaid or SSA upon setting up a trust, because they're going to be typically looking for that verification that the person properly spent down the funds. And pooled trust is available to people of all ages. I touched on this a little bit earlier. And this is particularly for first party trusts, when a person needs to fund a trust with money that is in their name, their own funds. Once a person is over the age of 65, they're no longer able to add money to a standalone special needs trust or create a standalone special needs trust after the age of 65. However, if they're over 65 and they have money that needs to be spent down, they can use a pooled trust. Now, there are some things to consider when someone is over the age of 65, things like look back periods for Medicaid long-term care services, and also penalty periods for SSI eligibility. So if you have someone who's over the age of 65 and you want to learn more about that, we encourage you to contact us to learn more. And with a pooled trust, just like a standalone special needs trust, if it's first party funded, there is that same payback provision that the money that is in that trust account upon the death of the individual needs to go to repay Medicaid for the services that were provided to that person during their lifetime. Now, the goal of this trust is to use all of the money and give them access to use these funds throughout their lifetime. We don't want to see someone, pass away with a large sum of money in the trust. But in this case, instead of it going to repay Medicaid, it's actually retained by the not-for-profit organization and used to provide services to people with disabilities that are served by their philanthropic mission. We do have one first-party program which can allow for some of the funds to go to other family members if we're able to satisfy the person's Medicaid lien at their death. However, most of the people who we work with, the funds that are left are far less than the cost of their Medicaid lien at that time. However, for the third-party program, just like other third-party special needs trusts, there is not a payback to Medicaid. So why, and some of the benefits of using a pooled trust, why someone might consider using this program. The first is, as I've mentioned with the documents, it's a very quick and easy process to establish a pooled trust account. If you have a need to set up an account quickly, or you're concerned about the costs of establishing a standalone trust, this is a really quick and easy way to get started. And it's typically very low cost to set up and reasonable expenses to maintain on a monthly basis. Pooled trusts are also able to accept trusts of all sizes. We don't have very high minimum funding requirements. Our first party programs, you need $300 to get started. And so this is something that makes this service accessible to many families and trusts of all sizes. As we've mentioned, you also get that benefit of working with an experienced not-for-profit who's going to serve as trustee and administer that account. An organization that has years of experience working with people with disabilities and successfully protecting their financial eligibility for means-tested government benefits. In our program particularly, you get that added benefit of working with KeyBank, who on their own is a corporate trustee, a fiduciary, and has extensive experience in managing assets in a way that is going to maximize the benefit of those funds for the individuals that we serve. And by working with a not-for-profit organization, you're going to have access to a team of representatives who understand the needs of the people that we serve, and can provide a personalized level of service to your loved one. It also gives you the ability to take a step back and not have to be that person. The trustee, not-for-profit, can be the one that has to say no in times where perhaps the purchase that the beneficiary would like to make may not be in their best interest, and you don't have to be the one to do that. We also offer a variety of tools that make it easy to manage the activity in an account by going online and tracking account information there, where you can check your balance, track to see when expenses are being paid, and also access the documents and forms you need to manage the account. You can run verifications of deposits into the trust directly through that tool. And for people who aren't as comfortable online, we also have an automated phone system. So it makes it very easy for you to manage the account, even during times where the trust is not open during our regular business hours. So NYSARC Trust Services has been administering special needs trusts and was the first program in New York State to administer pooled trusts. NYSARC actually was part of the organization of people who actually petitioned to the state to have the law change that allows organizations like ours to administer special needs trusts on behalf of the individuals. And we are very excited to now offer a third-party pooled trust program, which allows us to expand our services to families of people with any type of disability. This is an irrevocable third-party pooled supplemental needs trust. It requires an initial opening deposit of $10,000. So that makes this really very accessible to a family who has some money now that they would like to set aside for a loved one, but also for families who are planning for the future and may have a more modest estate. Traditionally, NYSARC Trust Services has offered third-party trusts to the individuals who we serve through our not-for-profit if they have qualifying intellectual or developmental disability. And so this program now allows us to serve people with any type of disability, and we're no longer restricted to only working with people who have an intellectual or developmental disability. And it's funded by a parent, a family member, it could be a friend, really any third party that wants to leave funds to an individual with a disability without jeopardizing their financial eligibility for benefits. That funding could be coming from a trust. It can come from many different places. And once this trust is set up, it's important to note that it can receive funds from any third-party source. Now, you may choose family members within, your family may choose to establish their own trusts, or this could be something that you set up and inform all of your family members of, and anyone that wants to leave funds to your loved one could name this particular trust. One of the things that we've created to help families through that process is a sample letter that helps you to reach out to your family, help them understand why you've set up this trust for your loved one and why it's important that they don't leave money to your loved one directly. So that's a resource that we will make available. And as I've mentioned, there's no payback provision to Medicaid for this trust program. So NYSARC does not retain any of that money that's in the trust account upon the death of the individual. And so the primary donor, who is the individual who establishes the account and is the primary person donating funds into the trust, will designate residual beneficiaries on the application when they join the program of who should receive the assets that are in the trust upon the death of the beneficiary. So if you're interested in getting started, we're going to talk about kind of the requirements of how you set up this trust program. And it's a little bit different in the sense that it is a pooled trust. So in order to name this trust in your estate planning documents or as the beneficiary of a life insurance policy, the trust itself has to be established. And so in order to do that, the donor must complete a joinder agreement during their lifetime. So that's the first step. Apply to join the pooled trust by completing the joinder agreement. We're looking for basic demographic information about you, about your loved one, where the funding is coming from, who should have access to the account, where should we be sending information like tax documents, forms to manage the account, and information about who your residual beneficiaries of the trust should be. That document needs to be signed and notarized. And we need some supporting documentation. Attach a copy of the beneficiary's Social Security card. So that is the person who is going to be benefiting from the trust, your loved one, and their Social Security award letter that allows us to verify their benefits. Depending on how you choose to fund the trust, there may be some other required documentation, or if perhaps the trust is being funded by court order, which may be very rare in this instance, but there may be some additional documentation required. And all of that is detailed in the information and procedures document for this trust. So we encourage you guys, we will be sharing copies of these slides following today's training. There's a link here, you can click directly to it or go to our website. All of these documents are available there as well. Once the application has been filled out, you've provided the supporting documentation, it is simply a matter of funding the trust. And so you can either fund the trust with a minimum of $10,000 if you choose to do that now, or if your plan is to fund the trust with proceeds from your estate, you can establish the trust by paying a one-time enrollment fee of $750, and we can open the account unfunded. That way it's open and available, it can be named in your estate planning documents, and it's there to receive the funds when the time comes. Now, this is a program where the funds are being managed by a professional trustee. And so there are costs for the services and the administration of the trust. As I mentioned, there's a one-time enrollment fee of $750 that covers the process of applying and joining the trust, the use of our master trust and joiner agreement documents, and gives you access to our team who can assist you through that process. NYSARC can also provide attorneys with beneficiary designation language. We've drafted a document that you can refer to so that you have the proper legal names for the trust and have the information you need to properly name that trust in various estate planning documents. In the event that you choose to open the account unfunded, there is an annual cost of administration of $50 a year that would be charged on the anniversary date of the account being open. And that covers the costs of our services to communicate with you and work with you throughout the process until the date that the trust is funded. You may need to make updates to your residual beneficiaries. We'll check in with you once a year. We want to be sure that we know about changes in your loved one's life, maybe changes about how they may want to use the money. We're really relying on you to give us as much information as you can while you are here, so that we are prepared to really serve your loved one the best that we can by really understanding their needs. If you're opening the trust with the minimum opening $10,000, there is no annual cost of administration. You would be charged monthly fees for NYSARC to administer the account on behalf of your loved one, and for the financial management of the assets in the trust that goes to KeyBank. Collectively, our fees are just over 2% a year, which, as I mentioned, is really reasonable when you compare it to other professional trustee options that are available to you. Beyond that, NYSARC handles all of the tax preparation for the trust, and we have an independent auditor who comes in and audits our operations once a year. And so that is charged annually in July, $100 per trust. And as I mentioned earlier, if you were doing this on your own, you may need to hire someone to provide that tax preparation. And typically, again, that's going to be much higher than this $100 a year. Beyond that, those fees cover all trust activity. There's no limit on how many requests you can submit. There's no limit on, how often you can communicate with us. We are here and we provide a variety of services as part of that. The only other cost that the trust will incur, other than, expenses for copies of checks and, more direct expenses, there is a 1.5% cost for the closing costs upon the termination of the trust. And as I mentioned, the fee schedule is publicly available with much more detail than this right on our website at NYSARCTrustServices.org, and also linked from this slide. So if you have questions, we encourage you to go check that out and contact us if there's anything that you have questions about. So beyond that, many people might be thinking about, how am I going to fund this trust? What would be some of the assets that I might be able to put into this trust? Primarily, most of these trust accounts will be funded through the donor's will or estate plan. It's going to be, funds coming from a life insurance policy, perhaps an employee or a retirement benefit. A lot of people also have real estate may be their largest asset. That may be something that you want to ensure goes to your loved one. One important thing to point out is that NYSARC only accepts cash-based assets. So it doesn't mean you can't leave your home to your loved one, but just that they may need to sell that property and put the assets from the sale of that home into the trust if they want to use NYSARC Trust Services for that. If you're looking for someone who can manage real property and actually hold the home in the trust, NYSARC would not be able to do that. And beyond that, you can make a gift or a bequest during your lifetime. So if you have funds now, or you have someone in your family who has money that they want to leave to your loved one now, you can also use the trust for that. Now, with that, I'm going to turn things back over to KeyBank, and they're going to talk a little bit about retirement accounts. Retirement accounts are often your largest asset. Many families, that is what we're putting money into throughout our lifetime, and that's where a lot of our assets are tied up in. And so we're going to talk a little bit about the process of leaving funds from a retirement account to a trust for your loved one, and what are some of the benefits to doing that under this new SECURE Act, which is the new law of the land. And with that, I'll turn things over to you, Cindy.
All right, sounds good. Thank you, Sarah. So you can go to the next page. So like Sarah pointed out, there's many ways in which you can fund a third-party pooled trust, which is fantastic. So anybody from your favorite school teacher to mom and dad, grandma, grandpa, they can leave assets to you now during their life or through their estate plans and fund the third party for the benefit of the disabled child or adult. The SECURE Act, let's take a look at this. So pre-SECURE Act, so before this even came into being, most people could call what they did stretch your IRA. So if mom and dad had an IRA, they could stretch that out for the lifetime of the beneficiary, and that can continue on. So you're not taking such a big tax hit and having to sell out of the IRA, which is basically what the SECURE Act is doing. So they eliminated that whole stretch option, and they said now it has to pay out within 10 years. But there is a great exception, and that is for those individuals that are disabled or chronically ill. There's other exceptions as well, but today's purpose, I'm only going to focus on the disabled. So if there's a disabled individual, mom and dad can leave IRA assets to that through a third-party trust. It is a fantastic planning tool, and it's a key element to help mom and dad, because like Sarah alluded to, and she's right, two largest assets of families are their home and their retirement assets. And it could be any type of retirement assets. So anything, if you're thinking about it, from a traditional IRA to there's different ones called simple, SEP IRAs, 457Bs, qualified plans, 403Bs. There is like a laundry list of types of qualified assets that you can leave to a third-party pooled trust for the benefit of a disabled individual. So there's a lot of words on this page, and we are going to share this afterwards. I just want to point out the biggest thing right now, and that's the third-party pooled trust and this great new tool that NYSARC has created. So it's an accumulation trust, and what that means is that if mom and dad were to pass away, and leave the IRA for the benefit of their disabled individual, they're going to have to utilize their beneficiary designation form and make sure that they're not leaving it to their son directly, John Smith, but they're going to leave it to the third-party trust for the benefit of John Smith. And what that does is that in inherited IRA, when mom and dad pass, those assets transfer into an inherited IRA wrapper. So you still have that IRA wrapper around it. But what happens with the accumulation trust is the beneficiary is the trust for the benefit of John, and that is a measuring life. That is a human, okay? As long as there is a human that is named as the remainderment or the contingent beneficiary, you're not going to have to use that 10-year payout. You can actually take the required minimum distribution, use that individual as the measuring life, and then take that required minimum distribution each year from the IRA and then transfer it into that third-party pool trust, which is what we're talking about here today. It's considered and called an accumulation trust for the purposes of you don't have to pay that out. The trustee does not have to pay that out every single year. It can accumulate the required minimum distributions for when there's a need. It's when somebody has to utilize a conduit trust, or most typically it's considered a first party trust. If that is utilized and an IRA is left either directly to that individual, or maybe that individual did work and has a little bit of retirement assets, when the required minimum distribution is calculated each year, it has to, and it's transferred into that first party, it has to pay out each and every year. Therefore, the beneficiary has to pay tax on that. This way, the accumulation trust, the beneficiary isn't paying tax, the trust is paying tax, and the beneficiary is only paying tax when distributions are being made from that third-party trust. So it is an incredible tool that can be utilized for the estate plans. And I have had a tremendous amount of conversations with families, with individuals with disabilities on what does this look like? How can I move my IRA from myself when I pass to support my disabled child and not have to cash it out? This is the tool. This is exactly what you need to utilize that and to actually save any kind of tax here. So you can keep that in the IRA wrapper. That's why the partnership is so good here. So in working with NYSARC and you're working with Key as co-trustees together, we're able to keep those IRA assets in that qualified wrapper. So Sarah, if you jump to the next page here, what I want to talk about is just a couple of high-level planning points. So the most important thing is to remember that the disabled beneficiary is, based on the Secure Act, is part of the excluded classes that does not force that 10-year payout. And it's really important that you do talk to your attorney. Talk to your CPA to make sure that the planning is correct. Even if you only have, like Sarah said, a life insurance policy, an IRA, and your home, that's really important. When you add up those assets, that's pretty significant. And you want to make sure that you're doing it correctly and there's no misstep where at the end of the day, it is being taxed and you don't want it to. It's like trying to figure out how to do that. And I always say this, it's like, I've been working with many attorneys and they're all wonderful, but you wouldn't go to an eye doctor if you had a heart condition, right? So when you're really communicating and you're trying to put your estate plan together, make sure it's an elder law attorney or someone that understands special needs. That's truly important because they will understand the Secure Act and how it affects individuals with disabilities who are trying to receive in assets. Like I said, this third-party pooled trust is the key element for families when they're trying to adjust their estate plan so that they can get the maximum amount of funds to their child or their adult child and have it protected so that they can remain and have benefits at the end of the day. The most important thing with these beneficiary designation forms is that they're all, and I air quote it because it's everything that you read up on it says it. They have to be human so that it's a measuring life. If you leave a charity as part, you say, I'm going to leave 10% to charity and 90% to the trust for the benefit of my child, you just blew it at that point. It truly has to be a measuring life. So that's why it's a simple beneficiary designation form and all qualified assets, your 401k, a traditional IRA, your 457B, all of these types of retirement assets, they all have these beneficiary designation forms. So I would make sure you grab that form, read through it, and then speak with your attorney and say, am I filling this out correctly? Because I've already set up my account with NYSARC. I have my third-party pool trust ready to go. Here's the name. Now what do I do? So it's truly important that the steps that you're taking, that you want to make sure that that form correctly states the trust, the third party trust for the benefit of the love of your loved one, so that when you are not here and that those IRA assets are rolling into that inherited account, that everything is done correctly and that we're not having to cash that out and create a taxable event to get the funds into that third party pooled trust. So with that, I just want to, like, again, there's an awful lot of words on those pages, but I wanted to, we'll share them later, and we're happy to continue the conversation. Just reach out to Sarah. And with that, Vince, I know that you kind of touched on the overview, and I know there was one question in the chat.
Yeah, there was one
Key
question.
Bank.
Here's some of our stats. You know, like I mentioned earlier, we're the 11th largest U.S. bank out there. We are headquartered in Cleveland, Ohio. We do operate in 31 states. Our fiduciary trust charter allows us to operate in all 50 states, so that's very important as a fiduciary. You can see again some of our stats there. The amount of clients that we have, 3.5 million. Total deposits, $136 billion in deposits. So very, very sizable U.S. bank in the United States. So hope that answers the question of who we are and how we operate.
With that, Sarah, we'll turn it back to you.
Wonderful. Thank you both. I really appreciate you guys joining us today. That really concludes the content of today's presentation, where we're talking about, different tools that are available to you, and specifically this new third-party pooled trust program that we offer. I did put up here on the screen just a quick reference for all of you of a comparison chart of our various pooled trust services. This is something you can access on our website. It gives you a really good high-level overview of the different programs that we have available. As you can see, most are first party. We do have a couple of third-party trusts. It talks about what is the required minimum funding for each of our programs and what happens to money at death, which we'll talk a little bit more about as we go through some of these questions. But we encourage you guys to go to our website, check out the resources that we have available there, and sign up for our mailing list if you're not on it already. We often give trainings like this on various topics throughout the year, and you might benefit from receiving our emails where we provide updates regarding changes to benefits and other laws. And as Cindy mentioned, we really want to encourage you guys to contact us with questions. We will certainly go through some of the questions that people have posed so far, but a lot of these come down to a person's individual situation. The answer is not always a clear yes or no. So if you have questions following today's presentation, please contact us. KeyBank has been generous enough to offer to meet with families who are really at the beginning stages and want to just talk about their estate planning goals. We can have, a high-level 30-minute conversation, and we can help prepare you for a meeting with an attorney or a legal professional who's going to be helping you with your estate planning. So, again, please do reach out to us if you have questions. So with that, I did take some time while you guys were talking to go through some of the questions and kind of organize myself here. You did answer, KeyBank, one of the questions that was on there about where you guys are located. So thank you so much. We appreciate all that information. A number of people have also been asking about the resources and materials from today's training. My colleague Nina dropped into the chat a link where you can download a copy of these slides, in addition to some detailed information about the new third-party trust program. So if you haven't already, feel free to go to the chat and grab that link. We will also be emailing that link out to everyone who registered for today's training, even those who were not able to participate in the training. So that link will be going to you directly via email shortly after we close today. I also want to let you know that this training is recorded, and so we will be posting the recording up on our website at NYSARCTrustServices.org. I'd say give me about a week to get it up there, but just check back over the next week or so, and that will be there for you to rewatch or share with your clients, other members of your family, anyone who may benefit from this training. So there were some questions about what to do if someone moves out of New York State. I mentioned that NYSARC's trust programs, we serve people who are receiving benefits in New York State, and we specialize in understanding New York-based benefits. Pooled trusts are available as a federal and state programs. So you can get a pooled trust in just about any state in the country, or find a pooled trust program that serves your state. And so in the event that someone was using one of our programs and they needed to move out of New York, we can certainly assist them if they need to transfer assets to another trust, given that we really specialize in New York-based benefits. It really will depend on that person's situation, kind of how we would handle that at the time that someone chooses to do that. But I want people to understand that the individuals we serve are free to move to other states as they see fit. If we're able to continue to administer the account, depending on what state they're in, we will continue to do so. And if not, we can certainly connect you with someone who may be able to assist. There was a question about setting up a third-party SNT, and let me just quickly refer back to the chat to remind myself what that one was about. So the question was, if someone needs to set up a third-party SNT and there's not a family member who's willing to serve as the trustee, if they can use the third-party trust that's administered by NYSARC, would they simply create the trust and then name it as the beneficiary of their retirement and under their will? So yeah, and this question came a little bit earlier in the presentation where we did go over this. The process would be to complete a joinder agreement to establish the trust if the person has not already created a third-party SNT. Now, we also get questions a lot of someone has a third-party SNT and the individual who was designated to serve as trustee no longer wants to serve or is no longer able to serve. Can NYSARC serve as the trustee? And the answer to that is, at this time, we are not able to take on serving as the successor trustee of an individual standalone trust. So that doesn't necessarily mean that you couldn't use the third-party community trust program. It simply means that they would need to essentially close out that trust that they have and fully distribute the funds that are in that account to a third-party community trust that NYSARC can administer as trustee. There was a question about who makes requests to the trust. Is it a loved one? Is it the beneficiary or an advocate? The answer for our programs would be that it can be any and all of those individuals. Some cases we are working with the beneficiary directly. They're able to manage their own account. They, work with us to make requests. They may name a couple of individuals who might assist them through that process. And those people are authorized when they complete the application to join the trust. You name people who are able to call and just communicate with us, and you can give them permission to submit requests. You can, restrict their permission to strictly getting bank statements. So it's entirely up to you, the donor, the beneficiary, to make that determination. And you can add and remove people as you see fit. So sometimes you might add the case manager that your loved one's working with, and a couple months later, they're now working with a different case manager. So you can call us and update those contacts. You can always make adjustments to their level of permissions. And that is, how they would submit requests to use the funds in our particular program. Speaking of what are some allowable expenses, one of the individuals asked about paying for pet expenses from the trust. And so I want to make sure for anyone who's been working with us for a while that we've been, we go through many things as rules change for Medicaid purposes. And there was certainly a time where pet expenses for someone who's in one of our first party programs may not have been allowable because of a very strict sole benefit rule. So I mentioned the primary benefit rule earlier, and that was recently changed. It used to be a sole benefit. And so when it was sole benefit, we tended to be a little bit more restrictive with paying for things like pet expenses from funds in the trust. However, now that they have really relaxed that law and more clarified the fact that we are able to pay for things that are not necessarily for the sole benefit of that person, but for the primary benefit. And as many of you can attest, I'm sure, I personally have animals in my life and how important they are to my emotional well-being. And for many of the people we serve, even beyond that, providing companionship and things like that. So pet expenses are certainly something that the trust considers. Now, keep in mind, if someone only has a certain amount of money in the trust and they need that money for their living expenses, that may be a reason why the trust is not going to pay the $600 vet bill. It's making sure that that person has their basic needs met first before we're able to pay for those types of expenses. And with that, that was another one of the questions that I think this is a good segue to, which is how does a trustee determine what's in the best interest of the beneficiary? So there's a lot of factors that go into determining whether or not something is in a person's best interest. Typically, when we're reviewing requests, the first thing that we're looking at is this for this person? Is this a bill in this person's name? Is this a service that's being provided to our beneficiary? Is this a purchase that is for their benefit? And the second is this something that's going to impact their financial eligibility for benefits? So we have to consider how every distribution from the trust could potentially impact someone's eligibility to receive services through Medicaid and SSI. That is one of our number one goals beyond making sure that the money is there for that person and used for their primary benefit, is to make sure that we're protecting their eligibility for those means tested benefits that they rely on day to day to support their needs. Beyond that, we're looking at how much money is available in the account and whether or not that expense is in that person's best interest. Perhaps they've got $10,000 in the trust and they want to use $5,000 to go on a trip. We might just have a conversation with the beneficiary, help them understand this is going to be 50% of the corpus in your trust. Is that the best way to use this money? Are there other things you're going to need in the near future? Are there expenses that you need on a month-to-month basis that aren't going to allow us to pay for that particular expense? So it all depends on a person's situation, their benefits, maybe what other things they have available to them outside of the funds in the trust. Because again, the goal is to ensure that that money is there throughout their lifetime to provide for things that they want and need. And so a lot of the times it's basic budgeting, those types of conversations that we're having, or just making a decision on whether or not this is a purchase that is going to allow them to do something that we know they're going to want to do a couple of months from now. So again, these decisions are not made in a vacuum without the beneficiary or the individuals that are named on their account being involved in that conversation. Most of the times, if there's something we're not able to pay for, there's usually something else that the trust isn't paying for that we could pay for that would allow them to free up some of the money they have outside of the trust to pay for that expense. So if you ever have a question about the use of funds in the trust or how to make sure that the funds are being used appropriately, we encourage you to contact us and, have a conversation. This is something that we're absolutely open to helping to provide other options and solutions that are going to ensure that the funds are being used appropriately for that person. Somebody asked about if they already have an SNT, if they should also have a pooled trust. Would it make sense for them to also have a pooled trust? That's really going to be dependent on what you mean by what kind of already have an SNT. If they already have a third-party SNT set up that their family is contributing funds to or is set up to have that money go to, it certainly doesn't hurt to have another option, but it may not make sense to be paying, another organization, then you're worrying about some money's here, some money's there. That might make the administration of that a little bit difficult. In other cases, it may be that they have a first party standalone trust and the family is looking to set up a third party trust for that person. Well, then sure, you can consider a pooled trust as an option that's available to you among, the other tools that are also available. So it really comes down to that person. And again, if you, want to talk through a specific situation or a specific client, we encourage you to contact us and just give us a little bit more information and we might be able to answer that a little bit more thoroughly. Josh Brody, our trust counsel, I just want to give him a shout out and thank him for responding in the chat. We had somebody who had asked about paying for the cost of the trust and if that comes out of someone's SSI payment. So the cost of our services to administer the trust don't come from someone's SSI funds. It comes from the money that they put into the trust account. So someone is funding a trust and our costs of our services come directly out of the balance of the trust. So people aren't paying for these expenses on top of what they're depositing into the trust. That's coming directly out of the funds that are held in the trust. And it also talked a little bit about if SSI funds go into a trust. And this is a little bit more relevant for someone who is creating a trust with their own money for a first party trust. Someone who's receiving SSI benefits is not necessarily going to put SSI funds into a trust. That money is there to be used for the services, food, and housing. That money does not need to be spent down. And so they do not need to put that money into a trust. However, over time, when people are not able to spend all of the money that they have available to them each month, in the following month, that can become an available resource to them. And they're only able to have up to $2,000 in their name at any given time. So if somebody has more money or they have extra money that they're not able to spend every month and that's building up in their bank account, that may be where they can make periodic deposits into a special needs trust to make sure that they stay below that $2,000 resource limit. And that's one way I think oftentimes people don't necessarily think of a trust as an option. Again, the first choice is going to try and spend that money on that person, something that they want or need. That'll be the most efficient way to spend down the funds. But if someone is working or is constantly going up against that $2,000 resource limit, a pool trust is a great option because you can make a couple $100 deposits here or there, and it's much more financially feasible than if you are, working with a trust that's not going to take on, deposits that are that small. All right, so that's all the questions I had written down, and I do see we've got a couple more messages here, so I'm going to take just a quick look at those. So Cindy, I may ask you to jump in on this one. So someone mentioned that the funds that are accumulated in a third party S&T pay taxes at the trust tax rate, not the beneficiary's tax rate. And that is correct.
Yes, correct.
Could you speak to that as it relates to the retirement accounts?
So the retirement accounts, if you think about it, that's why the third party trust is such a great tool, because the retirement accounts are going to stay in that wrapper. And then the RMDs, as they transfer each year into the third party pool trust, that is where you will, and if it's not paying out, those are the funds that are paid at the trust tax rate.
Wonderful. Thank you, Cindy.
You're welcome.
Okay. I'm going to read this one out loud in case, Cindy, anything jumps out at you. I can answer the first part of the question, which is it correct that if a nonprofit is named a partial contingent beneficiary of the S&T, say 10% at death of the disabled individual, to go to the ARC, for example, that supported them, and an IRA is left to the S&T, that the IRA will be subject to the 5-year distribution rule because a non-person is a contingent beneficiary. And I think you touched on this a little bit in your presentation. That
is correct. So if there is a non-measuring life, that is either a remainder or a contingent beneficiary, it's going to blow the Secure Act rule and have to do the short payout and not be able to extend it into the stretch. Once you add a non-measuring life in the mix, that is where it goes sideways. That is where it does not happen and you have to pay it out.
Wonderful. And thank you, Cindy, because this is
sure
a new rule. And, I'm sure there's many professionals on the line that are, benefiting from that discussion and understanding how that's going to work going forward. Someone asked about using, can the funds be used to deposit the yearly max to enable account after a person has passed away and the trust has been fully funded? This would be to help with housing expenses since it won't impact SSI, but ABLE would need to be continually funded. So This is certainly allowable in the sense that a person can fund an ABLE account with money from a trust. It's going to certainly be dependent on the trustee and that person's individual situation. I know for our program, some of the things that we're going to consider is how that money is going to be used, whether or not that person has direct access to that account, and if that's in that person's best interest. Keep in mind with an ABLE account, unlike an SNT, there's no protection to ensure that that money is not being used for someone else or by someone else. That beneficiary has direct access to the funds in an ABLE account. And so if they have someone in their life that asks them to pay for something, they can take money out of that account and use it for things that may not be for them and for their benefit. So I know in our program, when it comes to transferring funds to an ABLE account, we typically have a conversation with the beneficiary. We do some budgeting, and we tend to make transfers to an ABLE account to pay for specific expenses. Or if someone has a need to pay for rent, we might put the money in the ABLE account each month to pay that rent, things like that. But it's not to say that we would not ever put up to $16,000 into an ABLE account. It's just going to be dependent on that person's situation. And again, whether or not that's going to be in their best interest, if they're going to be willing to keep track of the documentation that they need to be sure that they're able to provide that to the IRS if they're ever audited and asked to show proof of what they're using the trust funds for. So that really is something that would be determined on an individual basis, but it is certainly possible. So somebody asked about what happens if the individual passes before the parents. So in the event that someone establishes, the trust and it's set up to receive their proceeds from their estate, and that their child predeceases them. In that case, certainly, the trust would no longer be established, and funded for that individual at that person's death. And I'm sure that what would happen in that instance would be detailed out in their estate planning documents or their will that would direct that.
And if it has to do with the IRA too, Sarah, so just remember the beneficiary designation forms, they're not irrevocable. They can be changed as often as you want. But again, conferring with your attorney before you make that change. So if the individual passes before mom and dad, then mom and dad just need to rework their beneficiary designation form.
Somebody asked if the standard pooled trust document is available for review by prospective participants. Absolutely. All of the documents for this trust program are available on our website at NYSARCTrustServices.org. In our main menu bar, there's a link that says Our Trusts, and it's the third party pooled trust. That gives you a nice overview, and you can click to the documents and forms page, download a copy of the joinder agreement, a master trust, information and procedures explaining how the trust works. There's a lot of really good, helpful, important information in there. And the fee schedule, if I didn't already mention that, I apologize. So there's a lot of great resources over there. Everything is publicly available for you to read, and contact us if you have any questions. So there was a question in here about the property going into the trust, someone wanting to leave property to be sold, but the tax consequence of the sale of that would be pretty large given how long they've lived in the house. However, if they put it into a trust and that person sells it, then the basis cost will be the sale price, and therefore they would get a much larger portion of the sale of that. So she's asking about why they can't leave property to an SNT to be sold. It's not that you can't leave property to an SNT. You can leave property to an SNT in the event that the trustee can manage that. It's simply NYSARC's trust programs. We, at this time, only accept cash-based assets. So that would be something to consider, and might be a reason why you would have a standalone trust and a pooled trust, something to protect your home, to receive those benefits of having that protected in trust, and something to, work with an agency that's going to help manage the cash-based assets of your estate. Managing real property in a trust is an immense responsibility. And perhaps, Cindy, with your level of experience in this, you speak to this a little bit, but it's just something that NYSARC's not doing at this time. It is something certainly that we are looking into. So certainly stay tuned and stay in touch with us. And Cindy, do you have anything to add to that?
Just with the real estate piece, if you're, it is an immense responsibility on the trustee to manage the asset, especially if the disabled individual is living in the home. But even just to have, you have to think about it. If the housing market, it depends on what the housing market looks like. So if the organization that's responsible for that house could be holding it for 18 months. So you have to make sure there's enough funds to cover real estate taxes, homeowners insurance, maintenance and upkeep, the home itself. So if you're thinking about all these things that you do to manage your house, if you're gone, then it's that organization's responsibility. That's why it's a lot of thought has to go into it before broaching the topic of taking in real estate. Again, I got 30 years and I've dealt with that for 30 years, and I know the ups and downs of real estate held in special needs trusts. So it's a huge undertaking.
Wonderful. Thank you, Cindy, so much. And with that, I think we have gotten to all of the questions. I double scrolled through the chat and Q&A just to make sure that we did get to everything. I apologize if there was anything that I overlooked. Again, we encourage you guys to contact us. Our phone number, email, website are all available here on the screen. Reach out to us. One important thing, I just want to again thank you, Cindy and Vince from KeyBank, for being here to really help shed some additional light on this topic. It's very much appreciated. KeyBank is our co-trustee. You still work primarily with NYSARC. And we can, and a lot of times people are like, do I go to a KeyBank location to make deposits, things like that? We want to ensure people understand that KeyBank is our co-trustee. We, through our office, manage the administration of the trust. So you never have to go to a KeyBank branch. And if you go to a KeyBank branch and ask them about your trust, they're not know what you're talking about. So again, I want to thank you guys for joining us and for extending that option to families to talk about their estate planning as they consider this new third-party pooled trust as an option to them. So do contact us if that's something that you're interested in, and we will coordinate some time with a member of their team who can answer some of your questions and help you get prepared for your first meeting with an attorney, or perhaps to meet with someone to update your estate planning documents. All right. So with that, we thank you all for who stuck around a little bit late tonight as we went a little over time. And thank you everyone who's been chiming in and just giving us great feedback and comments, thanking us for the information. So we appreciate your time and we look forward to the opportunity to work together in the future.
Thank you, everybody. Take care.
Thanks, everyone.
Good night.
Great job, Sarah.